Hello and welcome to Let's Talk Business. Now, markets declined for the second straight session with both indices slipping over 1%. Most sectoral indices dropped with non-banking financial services, banks, metals and realty sectors falling the most. Alex Matthew with the wrap of all the market action.
A day of heavy selling for the Indian equity markets, and the headlines look a little grim, with the Nifty 50 losing over 200 points or over 1% and the Nifty Bank falling below the 45,000 mark. Now, if you look at the picture under the surface though, you will see that most of that 200-point decline was accounted for by two counters. HDFC Bank, the worst performer in the Nifty 50, as well as Reliance Industries. In fact, HDFC Bank on its own accounted for half of those declines. We'll come to the why in just a bit. But take a look at some of the other factors. You had all of the sectoral indices lose ground in trade today, but understandably, the worst performers were the Nifty Bank as well as the Metal Index. Look at the top performers on the Nifty 50, few and far between, but they were the likes of Power Grid Corporation of India, Coal India, ONGC, Asian Paints and Sun Pharma. A bulk of the constituents lost ground, and the top losers were HDFC Bank, followed by JSW Steel, Reliance Industries, BPCL and Ultratech Cement. Now, talking about HDFC Bank, which was arguably the stock of the day, it lost because the management spoke to sell-side analysts earlier in the week and guided for a deterioration in asset quality on account of the merger with HDFC, as well as a contraction in the net interest margins, and that was not seen as positive by the street. Now, apart from that, Reliance Industries saw a large trade accounting for about 0.2% of the stake in that company, and that in fact was the reason why you saw that stock decline. Blue Star was another stock in focus, gaining about 13% on fundraising plans, as well as Apar Industries, which gained over 4% on higher volumes. Attention now obviously turns to the Federal Reserve decision on rates that will come out later tonight, and it's widely expected to hold rates stable. And besides that, we're also looking very closely at crude, which has been elevated. It is currently hovering around that $93.5 per barrel mark. But like I said, all attention to the Fed, and we'll see how that causes a reaction in the equity markets tomorrow.
All right, the spotlight on that crucial Fed outcome then. Now, a diplomatic fight between Canada and India threatens to put a freeze on growing economic ties between the two countries. Canadian fund managers have poured billions of dollars into Indian companies and projects. So how will the tensions impact both countries? Tamanna Inamdar joins us with all those details.
Diplomatic relations between India and Canada are not at their healthiest. The Canadian diplomat from India has been packed off. This is a tit-for-tat response to an Indian diplomat from Canada being packed off. But the question is, how is this going to impact investments by large Canadian institutions into India? Just for some perspective, over 1.7 lakh crore rupees in Indian equities and FDI has come from large institutional investors in Canada, including their famous pension funds. And that money has been building here over time. In the last couple of years, in fact, there's been a significant increase in the number of investments made. Now, there were concerns that such investments would be impacted, or future fund flows could be impacted because of the diplomatic issues between the two countries. But the market experts we've been speaking to seem to think that this is going to be a temporary issue. It's a political issue and will not impact investment decisions. In fact, Nirmal Jain has told us, of IIFL, has told us that investors are savvy and they know that business is business. Another market expert, Ajay Bagga, says that this is only a temporary issue and there's going to be no real impact on the investments coming in. One of the reasons that has been cited is that India is a robust democracy with very clear policies, and that is what investors look like. Also, the kind of friction coming in is being sourced to Justin Trudeau, the Canadian Prime Minister's own political headwinds and his own compulsions at a domestic level, which is leading to strife. So the word coming out there that no real impact on Canadian institutional investments into India, at least for now.
All right. Now, BQ Prime spoke to BNP Paribas' Manishi Raychaudhuri about the impact of the tensions brewing between the two nations. According to him, the tensions should not affect India's FII inflows. So how will trade be impacted due to this? Here's what he had to say.
Diplomatic relations between two large countries are of the nature that they seem to be currently between India and Canada. I'm just trying to understand, not with regards to specifically Canadian funds necessarily, but could pension funds or other funds of a particular nation, could the investments of those come under some bit of withdrawal if indeed relationships are like this? Are there past instances? Have you had a chance to think about this at all?
Right. So let me point out that, yes, some of the pension funds and other long-dated investments from that part of the world, the Western Hemisphere, their participation is no doubt significant in the Indian market. But having said this, India has also been in a relative sweet spot geopolitically over the past maybe 1 year or a little more than that. And we don't really expect that situation to change very drastically. Ultimately, investors, both foreign direct investors and portfolio investors, are interested in the fundamentals of the market, in the growth prospects and the government policies which are affecting the domestic economy. If this particular environment does not change significantly, we don't think either the foreign direct investment picture or the foreign portfolio investment picture would change significantly either.
US auto workers are on a strike against 3 legacy auto manufacturers, this over wage hikes and reduced working hours. How will the strike impact Indian auto component makers over here? Tushardeep Singh joins in with all those details.
When the US auto industry sneezes, Indian auxiliaries catch a cold. Such is the supply chain dynamics of an increasingly globalized manufacturing. On September 15, US auto workers under the United Auto Workers Labor Union started an unprecedented strike against 3 of the legacy Detroit automakers, General Motors, Ford and Stellantis, which owns the Chrysler and Jeep brands, over wage hikes and reduced working hours. The strikes could cost 3,200 vehicles daily, according to S&P Global Mobility, and if the standoff isn't resolved quickly, it could ripple through the US economy, according to Bloomberg. A second-hand effect of the strike is already showing among India's component makers, which supply these American heavyweights. In fact, Sona Comstar rang the alarm bells on the 3rd day of the protest itself. On Wednesday, Suprajit Engineering did so. The contagion is likely to spread to others as well, including Sona Comstar, Bharat Forge, Motherson Sumi, companies that have sprawling operations in the US. Speaking of operations, here are some brass tacks. In FY23, North America accounted for a third or $6.5 billion of India's auto parts exports. Of this, 28% comes from the US alone. Sona Comstar derives 43% of its revenue from the United States. Industry body ACMA has warned of future pain if the strike persists beyond a week. We are closely monitoring the developments in Detroit and remain hopeful that any issues will resolve in mutually beneficial manner for both the workers and the industry, ACMA's Director General Vinny Mehta said. Still, at least one industry watcher saw the impact as limited. One has to see this from a production angle more than an exports angle, and Alice told us because Europe is the larger export destination for Indian auxiliaries.
All right, that's all from Let's Talk Business.